Cast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome everybody. This is Mark Chaikin, founder of Chaikin Analytics. It's my great pleasure this afternoon to host this webinar for my good friend Larry McMillan. Larry's been around the block in the options area, not quite as long as I have, but long enough. And he's sort of like the guy in the farmer's insurance commercial. He knows a thing or two because he's seen a thing or two. And his specialty on the webinars that he's done to the Chaikin community in the past, which have been really well received, is volatility, the VIX index, and put call ratios. And what could be more pertinent today than volatility and sentiment? So Larry is going to share some of his indicators and what they have been saying about the market, and then make you a really special offer at the end. Larry's both a trader, a money manager, and an educator in the options area. Written the Bible of options trading called Options as a Strategic Investment, and has a website called The Option Strategist. So with that, it's my great pleasure to introduce Larry McMillan.
All right, thanks, Mark. All right, everyone. Certainly a very interesting time to be talking about the market. We're going to go over a number of indicators today and see what they're saying. Just as a background, Mark gave you a little bit of insight here. I was on Wall Street running a prop desk, and then almost 30 years ago, I started this company. We started out as a derivatives research firm selling data, newsletters, etc. But we moved into money management a while ago. We're both a CTA managing futures options accounts and an RIA managing, basically SPY and SPX option accounts. And we also do a certain amount of option education, including we have a mentoring program. So far this year, our managed accounts are up on the year. We had a very successful March trading volatility derivatives, and our newsletters are having their best years ever. Again, mostly for the same reason, but also because we had a number of excellent put-call ratio signals in February and March. So Mark mentioned there will be an offer, and I'll go over this later, but we are offering 30% off our two main newsletters at this URL, MCM April 20. The 20 stands for 2020, even though it's 30% off. And we will be sending you the PDF of this webinar and also a link to the recording. All right, well, let's get started. There are four main things that I look at. The chart of the S&P, of course, you can't make decisions about the price of the S&P without looking at the price of the S&P. But we also look at put-call ratios, breadth, and then a few things to do with volatility, primarily VIX, but also the volatility derivatives. So as we go through this, I mean, this was very important as we started down in early March. Oversold does not mean buy. The markets became oversold, well, really probably the first week. So maybe that week ended February 28th. Most indicators are already oversold by then, but as you know, the market continued on down for almost another 3 weeks. So we wait for confirmed buy signals rather than just jumping on the first oversold condition that comes along. And conversely, overbought does not mean sell either. We actually did have an overbought condition this week, it's first one since the decline started, and we'll be talking about that a little bit later. But again, the market was very overbought, let's say in February or January, but it really wasn't a sell until the sell signals were confirmed in late February. So here's the current chart of the S&P. It's just a couple of things I've marked on here just to kind of keep it simple. I've drawn the 200-day moving average on there, which doesn't seem to be a big deal in this particular market. We sliced right down through that without stopping much in early March. But we did bottom out down here at 2190 on the S&P and 2175 on the S&P futures. So whichever one of those you want to count. And ironically, there was a small support area back in December of 2016 at that same level. Unfortunately, what that means is when we traded there, we had wiped out all the gains since 2016 in a matter of just a few weeks. So when the market turns bearish, it can be pretty ugly. The blue circles are gaps on the chart, and you can see there's one down below there. It would fill at 2,300, I believe. That's right here. And then on the top side, there's 3 gaps there as well. We might be able to fill the 2 closest ones, but I'm not really that confident of that. Anyway, we've had this great oversold rally, and it rallied right up here. First of all, it broke through the 20-day moving average, which is that average right there, and it went on a little bit, which is typical of oversold rallies, and it got up here to almost the 2850 level. I guess it actually did touch 2850, and that has also been a bit of a support level back there. So now that is technically resistance. I mean, frankly, support and resistance have not meant a whole lot in this market. It just slices through pretty much everything, it feels like. But right now, we've had this oversold rally, and the question becomes, can it continue, or are we running out of gas? Here's just a little bit of a zoomed in look on it. And you can see that those 3 red bars there, that's the largest 3-day rally in percentage terms since 1931. It's nice there was that big rally, sort of, I guess worrisome that the last time that happened was right in the early stages or mid stages of the probably worst bear market ever. I think that market lost 89% from top to bottom. So, I'm not really hanging my hat on that too much. But again, you can see we rallied up there to the 2850 level, and then we've sort of fallen back off that a little bit, not much. This is the just to show you how bear markets can have these oversold rallies. This is the 1928 to 1933 bear market, but you can go back and test any of these. The first bear market that I remember trading was 1973-74, or at least trading, consistently, and that had a whole bunch of 20% rallies in there too. So 20% rallies are not that unusual in bear markets. For them to occur in 3 days, that is unusual. Usually they take a little bit longer than that to develop, but just to say that is some sort of like buy signal, it's not. So just to summarize here what we've seen so far, we sliced through all those support levels there. I didn't really talk about them, but we did blow down through all of those. We regained a couple of them. And now we should have some support at 2650, where it paused before breaking out on this last strong move upwards. Below that at 2450, and then those lows at 2175 to 2190 that I mentioned before. There is resistance here in the 2850 to 2900 neighborhood, and the oversold rally has exceeded the 20-day moving average now, which is usually indicating that it's nearing its end. So I'm still concerned about a retest. I mean, I don't know we have a full retest, but typically a decline of this magnitude does not get a free pass and just a V bottom. Obviously, 1929, there was a retest and they broke and went lower. 1987, we had a couple of retests, maybe not quite to the exact low, but pretty close. And then in 2008, of course, we retested and went lower. The eventual bottom was a V, but the first low in 2008, which was the crash-ish type behavior, 6 days straight down, very heavy losses, much like we had now, that was retested and broken. So, I don't really have that many sell signals right now, as you'll see, but I expect to get some before we have an actual retest. Now, we also look at Bollinger Bands, or actually a modified version of the Bollinger Bands. When John Bollinger invented the Bollinger Bands, he had to define volatility. So he defined it as this: the standard deviation of closing prices, which, to most of us seems to make pretty good sense as a measure of volatility, but that's not the way the math guys do it. So Black and Scholes have the option model, of course, and that's very important to our business since we're option people. And their definition of volatility is slightly different. It's the standard deviation of daily percentage price changes. And many of the math guys use that as their definition. So we're kind of forced to do that as well. So if we redraw the Bollinger Bands using that definition, we get them in a slightly different place. But we draw the 3 and 4 standard deviation bands around the 20-day moving average. And if the market moves outside the band, then back in, that's a signal. So we've had some very nice gains over the years with this indicator. And it is on a buy signal as of March 24th. I'll show you the chart in a second. But prior to that, it had 2 signals that were stopped out. So we have a trading system built around this. So on this chart, I'll just say right here, that's the +4 standard deviation line. And then just inside that, that's the +3 standard deviation line. So, for example, you can see that it moved outside here, didn't actually move back inside till there. So that was where your sell signal occurred. On the buy side, it came down here and then gave a buy signal there. The blue letters are failed signals. They get stopped out. You see you had an entry here and then went higher again, stopped it out. But it was short at the market top. It actually gave that sell signal mid-January. And the market actually moved higher in mid-February, but it did not stop that indicator out. In fact, I know a lot of indicators that gave sell signals in January and were a little bit faked out by the move to those further new highs in February before the market collapsed. But, we were still, fortunately, in that for our profits anyways, in that indicator. So on the way back down, we came way out and then moved back in slightly. That was a buy signal that was failed. Second one failed, and then we had this third one here, which is still in effect. Now, our target for these is the upper band. So you can see this is the +4 sigma band right now, and this is the +3 sigma band, and you can see they're falling at a tremendous rate. And the lower bands are way down here, and they're rising at a tremendous rate. What's going on is that realized volatility is decreasing now, so the bands are contracting back towards your 20-day moving average, which is right here. So this has almost reached its the upper band. I think we are just up a little today. Probably hits it within the next day or two. So that buy signal has essentially fulfilled its prediction. Here's just a closer look at it. That was the sell signal in mid-January. Right here, we moved outside, and then inside. And then coming down, we were outside and inside, and that was stopped out here when we moved back outside again. We moved inside here, that gave a new buy signal, that was stopped out, and then finally outside and inside. And then that's the one that we've seen, the rally all the way back here to 2850. So, the chart of S&P, I think, is still bearish because it's trending downwards. Your 20-day moving average has started to lift a little bit, but the Bollinger Bands, the upper bands, are still coming down. Your 200-day is coming down. So until some of that longer-term stuff improves, we'll have to see, where the next level down goes to. And I'm not saying it would even break to new lows. Although it seems to me, I'm seeing on TV, a lot of people are saying, they expect the market to move back down, but not to new lows. That's a pretty narrow definition of how you can be right. So right now, we're still viewing the major trend of the chart as negative with some, positive counter trend buy signals in between. And speaking of counter trend buy signals, let's talk about the put-call ratios. So we use the equity-only put-call ratios to predict the direction of the broad market, S&P, and that's all stock options that trade. So millions of them trade every day, and even more so in the last month. The indicator was created by Marty Zweig back in the 1950s when he was taking option volume out of the ads that were running in Barron's, run by the put and call dealers of that day, the brokers of those days. Anyways, it's a contrary indicator. So if too many people are buying puts, and we'll have to define what too many means, but if there's too much put buying, then we want to do something opposite, something bullish. And if there's too much call buying, then we want to do something bearish. So simplistically, this is the original ratio where you just used volume. Let's say at the end of the day in IBM, we sum up the volume of all the puts that were traded in IBM. Separately, we sum up the volume of all the calls. We divide the two, we get the put-call ratio. So since puts are in the numerator of the fraction, if there's heavy put buying, the ratio goes higher. But when is there likely to be heavy put buying? Well, when the stock is going down, right? That's when people buy puts. So it's moving in the opposite direction. Conversely, since calls are in the denominator of the fraction, heavy call buying will make the ratio go down. But when is there typically heavy call buying? Well, that's when the stock is going up, of course. So again, moves opposite. So the put call ratio moves opposite to the stock price in general. We keep a moving average. I use Fibonacci just in case there's something to Fibonacci. Anyways, this would be the ideal chart where the stock price and the put call ratio are completely inverse to each other. For example, as the stock is falling here, people are buying puts and making money. During a trend, the public makes money. It's just when the trend ends, they usually stay too long. So here, when the put call ratio rolls over and makes a local maximum, so a local maximum in the put call ratio is a buy signal for the stock. And at that point, then the stock would hopefully start to rise and the put call ratio would fall as people are buying calls. And to switch to the other side here, the call buying eventually culminates with a low or a local minimum on the put call ratio chart, and that would be a sell signal for the underlying stock. So this is not the current chart, but it's a chart of the S&P 500 index on top and the equity only put call ratio on the bottom, all stock options that trade. And you can see the inverse symmetry that exists most of the time. And that's why we use this ratio to predict the S&P. So here's the current chart. This is again just using volume, equity only put call ratio. So most recently here in the decline, it got to its highest reading in history. Now, for me, history is only goes back to 1993 on these charts that I have. So I don't have 1987 in there, but in any case, it got very high. So if we go to the scale here on the left, it got up to almost 100. That means 100 puts are trading for every 100 calls, which is a huge number in stock options. And stock options, the actions normally dominated by calls. So now this ratio is declining and the market is rising, and that's typical. And so this will be on a buy signal until somewhere along here it rolls back over and starts to head back up again. That doesn't seem to be in the cards right now. Here's the most recent local minimum that we had, and that, of course, is a sell signal. That was the lowest reading we had in 6 years, and of course, that was that mid-January sell signal, which we saw the market reacted a little bit, then went higher, and then back lower again. But you can see we never got a local maximum here; it just went sideways and then higher. So this put call ratio sell signal was still in effect during the decline. And these other, the local maximums are buy signals here. They're pretty good buy signals. Most of them sell signals are okay too. Here, this one, for example. So it's an indicator that we use quite religiously, and it gives 6 to 8 signals a year typically. So not a lot of signals. As the computers came along, we were able to do a little bit more with this, and we could calculate the dollar volume of the options that we're trading. So in theory, we could take each trade and multiply the option price of that trade times the volume on the trade. That's a very expensive way to approach it. That's a lot of real-time data, a lot of computer power. And we found out that we tried it for a while. It was tedious and expensive. And we found out that really, if we just did the end of day stuff, it was giving just as good a signal. So we used the option price at the end of the day times the volume for that day. And that gives us the dollar volume of that option for that day. So again, let's say it's IBM. We sum that multiplicand up for all the puts. Separately, we sum them up for all the calls, divide the two, and now we've got the weighted or dollar weighted put call ratio. And now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion, which is a very useful measure. And while the timing of the signals is not a whole lot different than the volume, the extremes on the chart are typically much more extreme. So for example, again, you can see we had a buy signal here in right near the low. Actually, these buy signals came in right right on the low, and that was the highest reading we'd had in 10 years, and it was near 190, which means $190 were being spent on puts for every $100 being spent on calls, which across the entire spectrum of stock options is a huge, huge number. Now, you might be asking, like, well, how long did it take us to decide that that little peak there was really a peak and not just some little thing that was going to go like that? We have computer analysis programs that treat this like a chess tree, so they know what's coming off the 21-day moving average. You kind of have an idea what's coming on, and they can do almost like a chess move calculation. So we had these timed the first day they turned down because the numbers coming off were pretty small. Pretty large, and the numbers coming on were starting to diminish. So we did call that. Even this little wiggle here, the computer program said, don't worry about that. And of course, they were right. And now we're heading down again. So this is a buy signal. You can see we had a sell signal in mid-January as the other one did. This one had a little bit of a fake earlier, though. And then the other signals here are about the same timing as the weighted chart. This one only got to the lows of a couple of years ago because if you recall, in early 2018, we were very overbought as well, and the market had a very bad February that year and struggled for a few months before, well, really for almost the whole rest of the year before regaining its footing. So just to summarize, we got buy signals right near the lows there in late March. Those buy signals are coming from extremely high levels on the chart, which typically means they're going to be good buy signals. I mean, in my opinion, they're already good buy signals. We've come a long ways. The previous sell signals from January were very good too. And looking forward, a reversal upward would be negative, but we don't see that as imminent right now. Now, another ratio that we sometimes watch is the total put call ratio. This is all stock and index options, not futures options, but stock and index options. This gave a buy signal on March 24th, and usually on these signals, we're only looking to get a 100-point gain in SPX. Well, we got that in 2 days, of course. In this last month or so, a 100-point gain has been a lot easier to obtain than at any other time in the past. In any case, in the 17 years since we've been using this ratio, there's only been 34 trades, so 2 per year. 25 have been winners, and 22 of the 25 have seen a 100-point gain. There's 9 losers, of course. So if we took all 34 trades, we were averaging a gain of 65 S&P points. So that trade is over. We are out of that trade, but we're still in the equity-only put-call ratio trade. Now, there's one other put-call ratio that doesn't get a lot of publicity, but it's the CBOE's equity-only put-call ratio. They publish statistics on their website every day, and this thing rarely rises above 1. It used to more often, but really since 2011, there hasn't been any time where there's been consecutive or even close together readings above 1.0. But this March, when we were in the midst of this heavy decline between March 19th and 16th, which was 6 trading days, the ratio was above 1 on 5 of those 6 days. Now, we have a system here. Well, it turns out that if you buy the last day, it's the best buy. But, of course, in real time, we don't know which day is going to be the last. So we have a system where we buy the second day. So this actually went long on like March 10th or something, premature. But it's now above those levels currently. So not the great victory that you would have hoped for with that kind of a reading, but a victory nonetheless. So we do watch for this also. It comes up rarely, but this is one of the times in history that it has come up. The only 2 other recent times that it had multiple days like that was in August of 2011, and then, of course, in the fall of 2008, in the beginning of the financial crisis. So what do we buy when we want to buy these things? So typically we're trying to predict what the S&P is going to do. So I want to have an option that's going to respond to what the S&P is going to do. So we're going to buy SPY calls, typically, or puts, and we want to have a good responsiveness. So we look at the delta of the option. Now the delta of a call option ranges between 0 and 1. So tomorrow's an expiration, April 17th, and right, SPY closed today at 279. So let's say you own an April 17th 300 call, and today SPY was up $1.34. Well, that call didn't move at all, so because it's expiring tomorrow and it's a long ways from 279 to 300, so that option has a delta of 0. On the other hand, if we are long, let's say in April, again the 17th, maybe a 240 call, something that's way in the money, then this was up $1.34, and our call would have been up that same amount. So the delta is 1. So the delta is just how much of the stock, the underlying stock gain or loss, does the option capture. So the higher the delta, the more the option behaves like the underlying. So deeply in the money options are like the underlying; they have high deltas. Deeply out of the money options are more speculative bets, casino gambling type things, and they don't respond nearly as well. So we're trying to buy something that will respond. So we typically buy an in-the-money option, and in normal times, when volatility is not as crazily high as it is right now, that would be an option just 1 or 2 points in the money. It would probably have a SPY option, and it would have a delta of 0.70 or higher. Now, in some of our intermediate term systems, like put-call ratios, which you saw only trades about 6 times a year, that is something that is less responsive. So we're going to buy an at-the-money option there. Slightly lower delta, but again, we don't pay as much for an at-the-money option as we do for an in-the-money option. So by doing that, we're trying to balance the risk of a little bit longer term holding period and the fact that we still want some responsiveness out of our option. So do we ever spread the options? I'm not a big fan of spreading bull spreads or bear spreads. I know on TV they do it all the time, but typically you'd only want to do it when the options are expensive, because otherwise you're cutting off your profit potential. And I know they say, well, you risk less, but you're still risking 100%. Well, you've got the bull spread on or a long call, so just buy a few less long calls than you would have done bull spreads. It's the same dollar risk, same percentage risk. But typically, I don't want to cut off my profit potential. But when the options get very expensive, then the spreads do make some sense. And so typically, when the market started down there in early February, you might have bought an at-the-money put and at the same time, sold an out-of-the-money put. The problem was that market moved so fast that it didn't really matter. Any spread was a bad spread. And the way you counter this is sometimes you widen out the distance in the strike. So right now, if we're doing a spread right now, I would have my strikes 15 to 20 points apart on SPY. A couple of weeks ago, we were using 30 points apart, because if you started out, let's say 8 points apart, and the S&P fell, fell like 100 points, so it just went blowing right through your short strike, and when that happens, you're giving away profit potential. Another alternative that some people use, and we do this sometimes too, if it falls to your short strike, then roll that down. That's assuming that the momentum is going to continue in your same direction. So I would only use spreads, vertical spreads, sparingly, but this is one of the kind of markets where you can use them because the options are so expensive right now. So just to summarize here, we've got our regular equity only put call ratios on buy signals, both the standard, meaning the volume, and the dollar volume weighted. The total put call ratio, and the CBOE. So we're sticking with this as a long position, even though I said the S&P chart is probably negative overall. We're staying with this until these ratios roll over, keeping some long position, intact, because the track record of these. They all have good track records. So let's look at a couple individual put call charts. On the individual put call charts, we treat them a little bit differently. We don't just take every local maximum and every local minimum as a buy or sell signal. No, what we want to see is the local minimums occurring in the 10th percentile or lower, let's say. Now you can't see back that far on this chart, but we look back 600 days, and that ratio has to be occurring at a level, let's say here 40-ish, 40-ish. That's in the lower 10th percentile of all put call readings over the last 100 days. This was not on the upside. The local maximums have to occur in the 90th percentile or higher. So that was not a particularly good sell signal. Disney moved sideways and then higher. However, this sell signal, which was then followed by another little sell signal, they were both pretty good. When we broke that level right there, we bought puts at this point. Even though rally back above there, once we're in the trade, we use the put call ratio as our indicator. We don't use the stock price as a stop out anymore. So you see this sell signal stayed in effect all the way down. And as Disney fell, we rolled calls down to lower and lower strikes. The calls kept getting, puts. We rolled the puts down to lower and lower strikes. The puts kept getting more expensive, though, so we finally just rode out the ones we had. And now we finally gotten a buy signal, a little bit of a fake out there and then an actual buy signal here. But we were waiting for this to rise back above that little high that it made there in late March. And if it can't do that, then I don't want to be in this trade. Now, Disney has struggled this week, and it's not, it's fallen back from there. So we're back down to 102 here. But again, if it can break through 108 and this put call ratio is still in effect, it might be something like that by that time, we would buy Disney calls at that point in time. Microsoft, I'm just showing this chart because Microsoft, the sell signals here in Microsoft were not good over the past year or so. You can see that these ones here, they're all blue letters indicating not successful. However, the put call ratio got so low in February, 20 calls, $20 are being spent on puts for every $100 being spent on calls. That's a ridiculously low number. So we said, all right, that's a sell signal. And if it would break that little level there, which was 182, we would buy puts. And we did, and we wrote it down. And, it's bounced nicely, and it's back on a buy signal right now. We're not long because it sort of got away from me on the upside, just kept going back up. But, again, that kind of extreme bullish, optimism, extreme bullishness in mid-February is just something you have to take as a good contrary signal. This is one we just got into recently and probably still could get into it. The China ETF, FXI. You can see that this buy signal now did occur in the 100th percentile, and then recently we went even higher. We got another buy signal there. I've already bought this, but if you want to wait for it to break out over that little level there, you could, and then add your position at that time. This is another current one that we're watching, which is cotton. Interestingly enough, these the put call ratio chart is constructed using cotton futures options. But you don't have to trade cotton futures options. You can trade an ETF sometimes. In this case, there's an ETF BAL, not real liquid, but we did get into it, and we acted on this sell signal back here. Got a very nice roll down out of it. We were sometimes in these. It's amazing what you can roll down for very nice credits. Every time you roll your puts down for a credit, of course, you're putting some money in your pocket. Anyways, now it's given a buy signal, and it kind of rose up here to this 32.5 level, and it's fallen back. So again, we're not really interested in buying it unless it can break out over 32.5, and this put call ratio is still in effect. But right now, we are watching this and would buy it if it closed above 32.5. How about crude oil? This is always a very interesting one. You can see that there was an extreme low reading here. This was the 0th percentile, and eventually gave us a sell signal back at that time. Then within just a couple of months, the ratio rose up above the 90th percentile, gave a buy signal there, which was not good. Gave a buy signal there, which took a while to get going, but was okay. And now we've come back. These, by the way, were not sell signals here because they were not below the 10th percentile. And now we've just gotten a buy signal here at the highest reading that we've seen in crude oil, I think as far as my charts go back. So you can see we're somewhere up in here, 280 or so. So $280 being spent on puts for every $100 being spent on calls. We trade this usually with the USO, which is the ETF. And so this is the price of the continuous crude oil futures chart, but similar to the chart of USO. And so this little peak right there corresponds to the 6th level on USO. So if USO breaks out over 6 and this put-call ratio is still in a buy signal, we would buy it. But again, it hasn't. So a lot of times you'll see that we are using conditional entry points, but I find I'm much more comfortable with those if we have a technical breakout combined with the put-call ratio signal. That's usually a pretty powerful combination. The third category that we look at is market breadth, simply advances minus declines. We can do a couple of things with it. One, we can keep a cumulative total, just adding them up day by day. Also, we can keep an oscillator. Our oscillator is 90% of yesterday's oscillator value, plus 10% of today's advances minus declines. Now, we keep 2 sets of data. One is New York Stock Exchange. That's easy to get. Everybody has that on your quote machines or wherever online. But there's a lot of things on the New York Stock Exchange that are not stocks, and so it sometimes distorts the advanced decline figures. So we also were looking for a stocks only advanced decline numbers. And while the New York Stock Exchange has something called their operating companies data, we felt that we had a better data set, and that's all stocks on which options are traded. It covers the whole gamut: big cap, small cap, NASDAQ, New York, everything. So our stocks only data set is all the optionable stocks. And we keep this oscillator. This is how it currently looks. First of all, I'm just explaining here. This chart goes back to 2013, so 7 years or so. And it's oversold if it falls below minus 400, and it's overbought if it rises above plus 200. Now, remember what I said before. So this is right here. This is December 24th, 2018, which if you were trading then, you certainly remember that dark day. The market had been going straight down into Christmas. This ratio got the most, not ratio, this indicator, oscillator, got the most oversold hit it ever been. But oversold does not mean buy. You actually buy when it stops being oversold, right there, which led to this massive overbought condition and this huge bull market coming out of that bottom. Now, again, overbought does not mean sell. So we stayed with this thing until there. When we sold, we got a little pullback in the market and then went higher again anyways. This was so overbought, such great breadth and such great volume that long-term bulls said that indicated that the market was going to be, on a bull market for quite a while, and it was. I mean, it was a couple of years almost. So it was a couple of years, but that all went by the board and what just happened, of course. So now we fell during March to a new oversold record, and we came out of that and we had a buy signal right in here. I believe that was on March 20th or 20, I think 24th. 23rd maybe. Anyway, gave a buy signal, and it went up so quickly, and the breadth was so strong that we got overbought. So remember, I said earlier there was one indicator that was overbought. This is it. It got overbought, but this chart is 1 day old, and we've already fallen back below here and given a new sell signal as of yesterday's close, the 15th. Breadth was negative again today, even though S&P and the Dow were up and NASDAQ was up. Breadth was negative 800 issues. That's not a good combination. I see the market's rallying really heavily right now. The futures are up another 35 points, so probably some news. I'm not really paying attention to the TV at this point. But in any case, this did give a new sell signal. So these new sell signals here, a little bit disappointing because I would have thought breadth would have been able to keep pace for a little bit longer. Breadth is often a negative divergent indicator, which is some worth paying attention to. For example, when the market was making new highs in January and February, breadth was struggling to keep pace. I mean, I think it'd be one day positive, one day negative, one day positive. Very, very difficult to do that, to keep pace. And so breadth was telling you that the market was laboring, even though S&P was going higher. Also, we mentioned the cumulative advanced decline line. That's another good negative divergent indicator. It made a new all-time high in January 16th in terms of our stocks only data, and never did after that. So by the time you got to mid-February, the S&P had been making a bunch of new all-time highs, and this was not. So that, again, was a negative divergent warning indicator. And we don't have that on the positive side, just the negative side. But we'll keep an eye on these, of course, going forward. And the cumulative advanced decline line is way, way, way below its all-time high now. So it'll be a long time before we get back to using that as a negative indicator. So finally, this brings us to VIX. So I want to finish up with discussing some things about volatility. First of all, the trend of VIX is very important to the market, and the market generally trends opposite to where VIX is trending. But we also, a second thing is that there are spike peak buy signals from VIX, and those are typically quite good indicators. And as long as we've been using these in a number of ways, I think I even learned something new on this latest move, which I'll show you in a minute. This is not the case now, but prior to, in late last year and early this year, VIX was very low. It was down around 12, 13, 14. It's kind of bumping along sideways. That's an overbought condition, but again, overbought does not mean sell. So anyone who tells you, oh yeah, I shorted the market because VIX was 12, I mean, VIX can stay 12 for a long time while the market goes roaring higher. So that's not a good sell signal just because VIX is overbought. Anyway, here's the current chart of VIX. So I mentioned the spike peak buy signals. They're marked with the letter B. And again, blue is unsuccessful, red is successful. So, for example, the first one, you might may not even remember this, but last year in May, the market kind of had a decline like that. And early in the decline, VIX spiked up and right back down again, giving us a buy signal. But the market continued lower and eventually recovered, of course. But I don't consider that a successful buy signal. It was telling you to buy there and the market went there. However, these were all pretty good. Even the one in late January, we were able to roll our calls up. What we typically do when we have long calls and market moves in our favor, we'll roll them up to a higher strike to take some credit out of the position and reduce our downside risk. Then I don't really have to guess as to where to place a stop or something like that. Anyways, then the market broke. And so VIX spiked up to here and back down again. That was a buy signal, but the buy signals are stopped out if VIX goes higher. So that was stopped out there. Then it spiked up again here and back down. It was stopped out there and eventually got all the way up here to wherever it was, 85-ish, and gave another buy signal. Of course, that was the good one. That was still premature in terms of market price. That occurred on March 17th. So the market continued on down from there, but it was excellent in terms of VIX price. So what I'm going to modify the way we play these in the future. We've always just played these with SPY calls, and I said I learned something. What I learned here is that, yeah, when VIX is low like this down here in the 12, 20 area or whatever you're getting these buy signals down in here. Fine, we play those by buying SPY calls because SPY moves a lot. But when VIX is this high, we can actually play this by buying VIX puts and not SPY calls. I mean, you buy SPY calls and they eventually made some money, but I think VIX puts would have made a lot more money there. Anyways, so the short-term indicator is still bullish. Now, these indicators, we have a system built around these, and it lasts for a month. So this signal right here, this buy signal, is expiring tomorrow. And, it's not that it falls off the cliff at that point or anything, but we did back test this a lot. And typically after a month or so, the results get pretty spotty. So this buy signal will expire tomorrow. But I mentioned the trend of VIX, and the trend of VIX is also very important, and that's more of an intermediate term thing. So this little purple circle here showed where the trend turned negative. The 20-day moving average here crossed above the 200-day moving average, and VIX closed above the 200-day. Those two things occurring simultaneously are a change of trend, and that gave us a sell signal on February 20th, like before the market actually broke. And then you can see it went higher the next day, and of course off to the races. And so right now, the 200-day is way down here. The 20-day is up here, is kind of curling down as VIX has come down below it. But in our opinion, and we back tested this as well, the trend of VIX, in other words, VIX is still dangerous. VIX could move higher easily with it still being up in the 40-ish level. Like when VIX is 40, I mean, stocks fly around, as you can see, they're still doing, and that typically is not really great for the market, not for the psyche of the market or even the overall price of the market when it's that volatile. So we're going to wait to declare this an all clear, where VIX would actually have to close below the 200-day. Now, if we go back to 2008, we had a lot of stuff like this. VIX came, you may not even remember, VIX went to 90, came all the way back to 35, went back up into the 50s, and the market had struggled and eventually turned down sharply. But VIX did not make this crossover back below its 200-day moving average until March of 2009, which is right near the actual bottom. So I'm going to remain cautious on the market until that happens, because there's a lot of things that go into VIX, a lot of psychological things and what have you, people buying protection, blah, blah, blah. But when VIX is this high, the collective wisdom of the market is indicating that there could still be trouble. So that's how we're interpreting that. So with this buy signal, the short-term buy signal is just about to expire. And I didn't mention that sometimes there were overlapping signals that we don't trade. The first one is the one we trade, and it lasts for a month. The 20-day, of course, moving average of VIX crossed above the 200-day, and that turned things bearish on February 20th, and they're still bearish in that regard. So we have the bearish intermediate term indicator of VIX, and the short-term positive nature of VIX is quickly disappearing now. So this is modestly negative. But the next thing we're going to look at is the construct of VIX. So you can't trade VIX. It's a very complicated formula. You can go read about it at the CBOE, but you can't trade it. You can trade futures on it, and you can trade options on it. And the options that trade on VIX are actually options based on these futures prices. So if you're buying, let's say, a June VIX call, and you think it's going to behave like VIX. No, it's going to behave like June VIX futures behave, which could be a very dampened down version of what VIX is doing. So you need to understand those things if you're going to trade VIX options. But here we're not necessarily going to trade them. We're just going to look at their prices. So if we look at the futures prices, so April just expired, so now May is the front month. And then typically you'd have May, June, July, August, and they'd slope upwards like that. That's called the term structure. So if the term structure slopes upwards and these things are trading at a premium to VIX, say VIX was down here somewhere, that would all be bullish. But right now, just the opposite is occurring, and I'll show you prices in a minute. But VIX is at like this price. The May futures are here, June, July, August, sloping downwards. That's a negative construct for the market, and that's bearish. When that happens, in fact, when it rolls over from positive to negative, which it did on February 24th, maybe the 5th, that's a very negative sign for the market. And of course, you can see what happened after that. So here's the current prices, or their last night prices, but I checked them late this afternoon. They're very similar. So VIX is trading at 40.84. And the May futures close at 36.58. Now, by the way, you can get the prices of all the May futures just by going to the CBOE website or the CBOE futures website, the CFE, and they have the delayed prices there of all the futures. So last night, the May futures settled at 36.58. So if we subtract the price of VIX from the futures, we get minus 426. So those futures are trading at a $4.26 discount to VIX. Now, among other things, at expiration, they do trade at the same price, or roughly the same price. So this is going to have to rise up, or this is going to have to fall down to meet that. But expiration is still 5 weeks away in this case. So a lot of things could happen prior to that. Anyway, you can see each of these futures contracts, with the exception of this one, I'm not sure why, continued on downward sloping. So the term structure is downward sloping. I'm just going to check and see if that went away tonight. No, that's still there. So something going on in October, I guess just people saying October is a more negative month. Anyways, so if we continue to make this subtraction all the way down, you can see that these longer term futures are trading at big discounts to VIX. Now, it was much bigger a few weeks ago. These got down to almost like maybe the minus 28 area. This front one was minus 10 or so. But it's still negative with the term structure sloping downwards, and these are all trading at discounts to VIX. Now you might say, well, I don't know where to get those futures, and even though I told you, there's a easier way to do this, and that is if you want to. The CBOE publishes 5 volatility indices every day. There's a 9-day. VIX is a 30-day, is a 3-month, 6-month, and 1 year. If we look at their prices, you can see that they're also sloping downward. So again, a quick way to get a handle on what the term structure is doing, and it's bearish. So here we've got these futures trading at a discount. We've got the futures term structure sloping downwards, the CBOE index term structure sloping downwards. So overall, that's bearish. Now, here's the caveat. When it reverses and goes positive, that is a buy signal. So when VIX is currently trading higher than the 3-month, this is the 30-day, it's higher than the 3-month. But when it closes below the 3-month, that's actually going to be a buy signal, which we will take in our newsletter. So despite my, perhaps bearishness about some other things, when this indicator turns positive, I think it's going to be pretty significant. There's a subsidiary to this also, is when the real short term, when the 9-day gets above all the others, which it is, and then falls below at least one other one, that's also a buy signal. I'm probably going to wait for this buy signal though, and it could be imminent. I mean, it's not that big of a discount right now. It's like 90 cents, so it could reverse, but it hasn't yet. So I don't jump the gun on these things. And by the way, if you get into that, the stop out is if it reverses back the other way. So there can be some friction, like you're in, you're out, you're in, you're out, but eventually you're in, and the market should move higher if that term structure behaves, slopes upwards. So just to summarize everything here, and then I want to make one more comment on volatility. The S&P chart, to my opinion, is still bearish. That modified Bollinger Band buy signal that came in March 20th, to me, has pretty much run its course. Technically, it could move up towards those other bands, but they're falling sharply. So, that's like trying to squeeze the last dime out of a trade that just made a whole bunch of dollars. The put-call ratios are still bullish. That's very good, I think. Red oscillators, as I said, moved to sell signals yesterday and stayed on those sell signals today. So that's, I'm not sure what news is affecting the market right now, but again, news has not had any particular lasting effect here. The trend of VIX is bearish, as we showed, with the 20-day is still greater than the 200-day. that VIX spike peak buy signal is still in effect for one more day, but eventually that's going to come off of there too. The term structure volatility, that's bearish. So what do we have here? Well, I consider this to be very, very important. You don't want to fight the chart. I also consider this to be very important too, the term structure here. So, and then of course this being very important too. So to me, the core position is still bearish. You should still be owning some puts or some put spreads, but you can trade this oversold rally. You can trade these buy signals when they occur. So we talked about the next one we might get might be the term structure flipping to a positive. We would definitely be trading that. We traded the put call ratios with their buy signals. We traded this buy signal. So it's not like we're just sitting here bearish hoping for the market to go down. We're maintaining a core bearish position, but we do trade these other systems against it. Now, I mentioned a bigger scope on volatility. I wrote a paper, and if any of you subscribe to our newsletters after this talk, you'll get a free copy of this paper. And I looked back at the Dow Jones Industrials and volatility, historic volatility and implied volatility, going back to 1928. Now, we don't have implied volatility going back to 1928. We don't have VIX really before 1993, except that the CBOE did a back test to 86 so that they could get the get VIX into the equation. But you can see that this volatility here, most recently, where's my pen? Got it right here to I believe it's like 106%. That's a 20-day historical volatility of the S&P 500. Crazy high, but not as high as 87 was, and not as high as 1920, it crashed at 29. But you can see in 29, even though the market, and there was the biggest fake out rally of all time, a 48% rally off the bottom of October 29 into April 1930. I'm sure people thought the all clear had been signaled. AT&T made a new all-time high. Implied volatility fell to 8%. I mean, historic volatility fell to 8%. Then the wheels came off, and you hit 1931, 1932. Volatility went crazy. And then, various other couple of times in late 1930s, it had a reflex. Well, technically, that's when they invented the word recession. And then Dunkirk, when it looked like that Germany was going to win World War II. After that, we never had the historic volatility of S&P above 44% until the crash of 87. Now, since then, we've had it a few times. We've had some other nasty things that have happened. In 98, here was the long-term capital crisis, a bear market there in 2002, after 9/11, of course, 2008, and then even the fall of 2011 was a pretty nasty time too. So, but now we're at a much higher level, and to me, when volatility gets to this high, there are ramifications. The market just doesn't usually say, "Oh, geez, that was a mistake, sorry," and just go right back up again. Maybe the closest thing to that happening was 1987, because that crash was caused by, an arbitrage strategy that went amok and caused, a lot of other people to pile in on the selling. This one, we were shutting down the world economy for a couple of years. I mean, I'm thinking a couple of years. I know they're not thinking that on Wall Street when they're buying this rally like this, but it's still shut down for a while. That's not the same as an arbitrage strategy gone badly on one afternoon. In any case, the whole paper is available to you if you subscribe to our newsletters. And during March, I showed you that we had great success in our newsletters and in our managed accounts because we were running a strategy we call the VIX SPY call hedge. I don't really have time to get into it here now, but it has to do with capturing that discount on the VIX futures as you head into expiration. So we have a webinar that we sell on our website for that. It's very cheap cost for that webinar. But what I'm really more interested in here is offering you the either our daily volume alerts newsletter or our daily strategist newsletter for 30% off. This is just lasts through next Monday, the 20th. And just go to this website, optionstrategist.com, MCM April 20. The coupon should automatically be applied, but if it's not, that's the coupon. Just quickly, our track record on the DVA has been excellent over the years, but especially the last 3 years. And we also, in this newsletter, play takeovers. So we just have been, in this last decline, the risk arbs got mauled. You may have seen where the big hedge fund Citadel sold out their entire position in Tiffany's, which is being taken over by Louis Vuitton, Moet Hennessy. And the deal is solid at 135, but they sold their position because they needed the money for something else, and they sold the stock all the way down to 103. It's back up now to 128, but there's still room in there. So we've been trading some of these. In fact, we traded this one Tallgrass Energy, which is closing today. BlackRock bought them, but that stock fell from like 22 to like 10 or something. On the way back up, we bought it at like 16, 17, and now sold it out today at 22. So we do those situations as well in that newsletter. In the Daily Strategist newsletter, there's 2 reports per day, and directional strategies as well as theoretical option strategies. So any of those, both of those are available at a 30% discount through April 20th. And just a couple of other things. We will be sending you the PDF and the link to the recording here. We have a YouTube channel. I record a market comment every Monday morning, so I invite you to subscribe to that. And we also have one Saturday a month where we get together and talk about the market, and that's going to actually be this Saturday, April 18th. So I invite you to take a look at all those things on our website. If you're interested in our money management, it's here at McMillanAsset.com. So that's going to conclude things. Mark was going to hang around, I think.
I have hung around. The reason the market rallied is Gilead has reported great success with their coronavirus treatment. I think that's called Remdesivir, and the futures rallied 2% on that news.
Yeah, that's good.
Yeah, so Larry, really like to thank you. Folks, you've just heard a masterful look at how a very successful money manager and option strategist uses tools to navigate what are very, very choppy waters. I happen to agree that in spite of the power of this rally that we've seen, we've still contained it in the 50% retracement area. So Larry's indicators and my very simplistic way of looking at bear markets, which is that they tend to retest and bad news has a way of surfacing, are in gear. But I would encourage anybody who believes that volatility and option premiums are the source of good trades to give Larry's newsletters a try. He gives you an awful lot for the money. The discount is a bonus here because if you're trading options or if you're looking for option strategies that are reliable and tested, Larry really delivers. And now that he's forced to be home with none of his staff there, he's really focused. So I always like someone who's focused and not distracted. And Larry has told me that, he has appropriately told his people to work from home, which is what we're doing. So Larry, I want to thank you. I hope everybody takes this offer seriously because it's a good one and you're dealing with a real pro. This isn't some fly-by-night guy. This is someone who's been there, done that, and is offering real value. So Larry, thank you very much and stay safe.
All right, Mark, you too. I did see we have a few questions here. I could take a look at, let's see. Is the standard Bollinger Band with 4 standard deviations? No, John uses 2 and 3. When options are expensive, why not just buy the stock? Yes, you can do that, of course, but if you're talking about S&P, if you're trying to, let's say, short the market, I mean, that introduces a whole lot more risk. The options give you limited risk, so that's better. Is there a way to isolate puts bought by corporate insiders? Every time I see somebody try to interpret the put-call ratios in that manner, it just, doesn't seem to work. I mean, I know there are people look at how much we're traded on the bid and traded on the offer and all those sorts of things, but it doesn't really seem to, improve things. It just seems to confuse them, actually. Did you ever study crosses of different moving averages? Yeah, we have for VIX. Yes, we have, but this is the one we're kind of focused on, and I think rightfully so. Right, October futures might be slightly elevated due to the October markets in the past. Yes, exactly. What is the minimum for asset management? $100,000 accounts. Do you also sell options? Well, that's interesting because we are going to be, yes, we do. And we are going to be beginning a new newsletter dedicated strictly to selling put options. So if you're interested in that, stay tuned, and I'm sure you'll be hearing something from us later. So if I do a spread later, can I sell one leg? Well, typically if somebody takes off a leg, it's the short leg, not the long leg on a spread. So, but yeah, you can do whatever you want. I mean, typically the reason you're in the spread was to kind of hedge your risk and sell an expensive option against a cheap one. I guess if the options get back to a cheaper level and the spread no longer makes sense in that context, then yeah, you could. All right, that's all the questions that were there. So now I'm going to officially end the webinar. Thanks for attending.